Welcome to the Pro Ticker Deep Dive. Today, we're focusing on Brazil's real estate sector. It feels like it's undergoing, well, a pretty major structural transformation. There's quite a bit of buzz, isn't there, around this new mortgage funding model. It seems like a really powerful policy lever. And I guess the fundamental question we need to tackle is, can this new framework genuinely spark, widespread growth in that massive housing market? Or is it maybe just a complex shuffle, just shifting existing capital around?
That's exactly the mission for this deep dive. We're here to extract the critical insights. We're looking at the policy changes, obviously, but also observing corporate strategies, specific ones, and analyzing key technical market indicators, too, just to get a full picture of the ripple effects. Because this isn't just about property, is it? We're really charting how this transmits through the economy, construction, retail spending, and, ultimately stock market performance for the builders.
Yeah. And the sheer scale justifies the attention, I think. We're talking about a planned injection, at least our $20 billion, aimed right at the housing market, all driven by this structural reform. Okay, let's unpack this.
Our $20 billion is definitely a number that gets your attention. It signals, a serious intent to change the rules of the game.
So let's start right there with the mechanism itself, this new mortgage funding model. Its main goal seems to be modernizing the savings and loan system, the SBPE. What exactly is the structural problem with the SBPE that they've been trying to fix for, decades?
Yeah, the core structural flaw, it's always been this asset-liability mismatch. Basically, credit was limited because the system just struggled. It couldn't efficiently match short-term savings deposits, which is where the money usually comes from, with the incredibly long life, the duration of housing loans. That fundamental imbalance, it really prevented a deep, stable pool of affordable housing credit from ever really forming. So modernizing the SBPE is absolutely critical for any kind of structural recovery.
But, critics might say, okay, our $20 billion, but isn't that just money being moved from other government pots or bank reserves? How does this structural reform guarantee genuinely new capital rather than just like shuffling funds?
Right, and that's a crucial distinction. The reform isn't just about allocating money. It fundamentally changes where capital can flow from. By modernizing the structure, they're paving the way for better securitization. They're trying to attract different kinds of institutional investors, people who, previously found the SBPE setup just too rigid or opaque. So they are $20 billion. Think of it as the initial seed capital. But the structural reform itself, that's the engine designed to pull in potentially much more private capital over time.
And what I find really interesting is how they're implementing it quite gradually. The key detail seems to be this parallel track strategy. The new framework and the old system running side by side for a whole year, this hybrid phase.
Yeah, that parallel structure, it's actually a pretty clever piece of policy engineering. It goes way beyond just giving breathing room. It actively manages systemic risk. By running both systems, the central bank avoids forcing, an abrupt liquidity shift. Existing loans are safe. Lenders can gradually adjust their risk models, their balance sheets, adapt to the new structure without that sudden shock. A shock that usually makes lending rates spike or brings projects to a screeching halt. It's really about smoothing the transition, potentially to lower, more stable rates eventually.
So what is this structural approach, focusing on the mechanism's efficiency rather than just short-term cash? What does that mean for you, the listener, trying to make sense of this complex economy?
Well, it means the changes should be more lasting. Stimulus packages, they come and go, right? They fade. But when you improve the core plumbing, let's say, of the capital market, you create a deeper, more resilient source of credit. And that structural integrity that encourages sustained investment in construction, ideally, it translates into lower long-term costs for homebuyers, too. It should foster more enduring confidence in the whole sector.
Okay, so while these structural fixes build confidence on the supply side, we absolutely can't ignore the major headwinds facing the average Brazilian consumer right now. We've seen some positive signals, sure, like better employment, some real wage gains, yet construction and property markets, they've definitely lagged.
Yeah, the problem isn't really supply potential right now. It's more about demand capacity. High credit costs are part of it, yes. Yeah. But the biggest barrier, honestly, is the consumer balance sheet. Consumer debt is just ballooned. We're talking levels not seen in, 15 years. And this is where it gets really interesting. You've got this potential surge in credit supply, that our $20 billion injection colliding head-on with a serious demand constraint from households already loaded with debt. That tension, that really defines the short-term outlook.
And the regional picture doesn't help much either, does it? Adds a layer of caution. When we look around Latin America, the economic pulse is, well, uneven. You see examples like Chile, right? A key regional partner. Inflation there is still sticky, still clocking in at 4.4% year over year.
Exactly. And that persistent inflation elsewhere puts pressure on Brazil's own monetary environment. It just does. When a major neighbor struggles to tame inflation, it naturally makes central banks, including Brazil's, pretty cautious about cutting their own interest rates too fast or too deep. And since long-duration assets, like huge construction projects, are incredibly sensitive to interest rates, that regional pressure ultimately dampens investor appetite for long-term real estate exposure. It doesn't matter how good the local housing policy looks on paper.
Okay, so given that consumer demand is sort of choked by this high debt load, we probably need to look for other signs, maybe secondary signs, of economic belief in the idea of home. Corporations often pivot faster than policy, don't they? And that's where some of these strategic corporate moves come in. They seem to show confidence in the existing home market, not just pinning hopes on new construction.
Absolutely. Yeah. And we have a fantastic example of this adaptation. Look at the online furniture retailer Madeira Madeira. They recently acquired Trider. And Trider is basically a digital marketplace connecting homeowners with local home service providers, plumbers, electricians, decorators, you name it.
Huh. That is interesting for understanding where the economic belief is actually shifting.
Yeah, it fundamentally shows that home is now viewed, strategically anyway, as a full-service, maintenance-heavy economy. If people are delaying buying new homes, maybe they're fixing up or improving the ones they already have. Makes sense. So by integrating retail, the furniture, the supplies, with services, the repair guys, the renovators, they're creating new ways to make money, new channels tied directly to home improvement and upkeep. It's almost like a strategic hedge against slow new home starts, right? Focusing on the sort of recession-proof need for home repair.
Let's pivot then to the specific data from the home builders themselves. They're right on the front lines of this tension. Operationally, how have they been doing? Their results seem pretty mixed. I saw third quarter launch and sales data was uneven. Some firms reporting metrics down, 20, even 30% compared to last year?
That's right. The operational picture is patchy. Yet, the stock market performance, specifically looking year-to-date, YTD tells a fascinating story of polarization. We've seen really significant upward momentum for certain names, especially those focused on high-demand segments. Take Tenda, ticker 10D3, incredible gains, up over 140% YTD. Cyrela, CYRE, also performed really strongly, up more than 60% YTD. It seems they've managed to navigate this high-rate environment better than others.
Wow, that's a huge divergence within the same sector. But then you have the laggers, the ones maybe reflecting that broader macro reality more closely.
Exactly. MRV, ticker MRVE3, remains a distinct underperformer. It's trading near its lower valuation band, roughly 0.7 times book value.
Okay, for our listener, just quickly, what does 0.7 times book value actually mean in plain English?
Right. Basically, it means the stock market values the entire company at only 70% of its stated tangible assets. You know, the land it owns, the cash it has, the properties on its books. Trading at such a steep discount, it tells you investors are pretty skeptical, either about the company's current valuation or its ability to generate future profits from those assets. They're pricing in some serious pessimism or maybe even expecting potential write-downs on those assets.
Let's circle back to the consumer for a second and how this debt situation affects overall spending. That high household debt, it keeps constraining buying power. And I found the details on where that consumer spending is going quite striking.
It is a striking picture, isn't it? Consumer spending power is being seriously squeezed by rising obligations. And it's not just traditional loans. We're seeing a surge in higher interest things like payroll loans, and somewhat surprisingly, a really rapid increase in spending on things like online betting. This diversion of immediate cash flow, it limits how much a household can realistically commit to a huge long-term asset like a home or even big renovation projects.
And presumably, this demand pressure then filters out beyond just housing into other sectors that depend on consumer health.
Correct. That weakness flows directly into areas like shopping mall operators, for instance. We're seeing their price to FFO multiples get compressed compared to where they usually trade historically.
Right. Can you quickly define FFO for us?
Sure. FFO stands for Funds from Operations. It's essentially the core cash flow generated by a real estate company, like a mall owner or a real estate investment trust, a REIT. It's kind of the standard measure for figuring out how profitable that underlying real estate business is.
Yeah.
So a compressed price to FFO just means the stock price is low relative to the actual cash flow the assets are generating.
And yet, that very compression might be creating a decent yield for certain types of investors.
Yes, exactly. For investors focused on income, those compressed prices are currently yielding somewhere in the 4 to 6% range. Now, that yield definitely appeals if you're chasing stable income payments. But you have to accept that the market is offering this higher yield precisely because of that perceived consumer risk we talked about, that demand constraint. It limits the expectation for big gains in the stock price itself, near-term capital appreciation.
Right.
Until that household debt picture improves, these are largely yield plays, not really growth plays.
Okay, we've laid out a pretty complex backdrop here. Let's try to systematically outline the key opportunities and risks. Tie this together for the listener. Let's start with the upside, the optimistic view. What are the main opportunities?
Okay, 3 key opportunities stand out, I think. First, obviously, the immediate liquidity injection that our $20 billion should boost housing starts, assuming, and it's a big assumption, smooth execution. Second, structural reforms seem to be gaining traction beyond just the mortgage model. Look at São Paulo's proposed property tax update that could really attract more private sector money, especially for middle-income housing. And third, that corporate expansion angle we discussed. The Madeira Trider model, it's creating these clever new ways to make money tied to the ongoing home improvement market, which seems pretty resilient.
Right. And on the flip side, what are the 3 major risks that could potentially derail this whole opportunity?
Well, the downside risks are significant too. First, execution delays. Bureaucratic friction, red tape, it's always a hurdle. It could slow down the actual implementation of the new mortgage model, holding up the money. Second, and maybe most critical, is that severe consumer credit risk. Demand is just fundamentally constrained by those debt ratios at 15-year highs. That translates directly into high potential default risk for any new loans issued. And third, that regional inflation persistence, like the Chile example. If inflation stays sticky elsewhere, it could stubbornly limit how much Brazil's central bank feels it can ease monetary policy, keeping borrowing costs higher for longer.
So when you put all this together, the policy push, the corporate hedging, this underlying consumer tension, the technical indicators from the market, what are they suggesting? Are we nearing some kind of turning point?
Yeah, the momentum indicators strongly suggest the sector is at a pretty decisive inflection point. Look, the market went through this long consolidation phase, right? Prices basically went nowhere for a while. But now, trading volumes are starting to build, and you can see investor positioning quietly rotating back towards real assets, back towards home builders. The market feels absolutely primed for a significant move. But, and it's a big but, it is entirely contingent on whether that $20 billion funding actually delivers credit quickly and efficiently enough to overcome that demand constraint we keep talking about.
Okay, so to summarize the core takeaway for you, the listener, this new mortgage model, it seems like much more than just a simple short-term stimulus payment. It feels more like a fundamental reset button for the housing market, really driven by deep structural reform aimed at fixing that underlying credit mechanism.
Absolutely. And the real opportunity, I think, lies in watching how that our $20 billion in liquidity actually flows and tracks through the system. If we start seeing clear evidence that it's translating quickly into strong pre-sales numbers, into new project launches by those home builders, especially the ones like Tenda and Cirila, who've already shown they can navigate this environment, well, then we could potentially witness the start of a really powerful, virtuous cycle of growth. It's quite a rare high-stakes moment, actually, where you see macro policy meeting micro price action almost in real time. It'll be fascinating to watch.
See you all in the next Pro Ticker Deep Dive.